Andrew Holland, CEO at Avendus Capital Alternate Strategies, joining us right now on the show. Andrew, great to have you. We've not spoken since the time we saw the index peak out and start its spiral move downwards. What's the gauge on equity investments right now? How should one proceed and tread this volatility?
Well, I think everyone should proceed with caution. It goes without saying, really, given the volatility. I think this is a pretty much a defining week because I think markets really now are expecting a coordinated and global response, whether that's monetary and fiscal as well, to this problem. Because it's not just a China problem anymore. It's a global problem. And we moved from those kind of expectations that it was just a China problem there to a supply problem to now really a demand problem. And I think that's what's spooking the markets. And they're trying to get a feel really for where global growth and earnings might end up. And I think the kind of the red pens in terms of the downgrades are still yet to kind of come to the fore. So I think the market's looking for some sort of stability or global response. And it's going to have to be a targeted response as well. And then we can start to kind of think about if the number of cases is starting to peak in the Western world, then what's the kind of landscape looking like? Say maybe April onwards, in terms of what the downgrades will be and which sectors will come out of it stronger. So I think that's where we are. Everything at the moment gets tarred with the same brush. So it's worth just sitting on the sidelines a little bit to see what the first response globally is.
Andrew, good morning. Niraj here. You reckon it will be a central bank stroke coordinated action from governments which will help us combat the issues surrounding credit right now and coronavirus spreading? Or would that be one of the measures which might just alleviate the pain a bit, not quite dispel the uncertainty due to the coronavirus?
See, it can't just be interest rate reductions. I mean, obviously that helps, but if you've got a demand shock in certain industries, then it doesn't matter how low interest rates are if you don't have the revenues and therefore the cash flows to pay back your interest, then you've got a problem. So I think whilst interest rates will be one tool, I think the other tool will obviously be kind of directing kind of credit or kind of fiscal help to some of those sectors which are under pressure, which obviously the kind of airlines, oil, travel, restaurants, small and medium-sized companies. So I think that's where the target needs to be, rather than just interest rates. Interest rates will help at the margin, but not when you have a demand shock. So I think it needs to be a response which is more targeted to those areas in the very short term. And I think then that would give the markets a little bit more a bit more confidence that the kind of credit risk which people are now finally coming towards will not be as bad. There will be casualties. There's bound to be. But if it can be limited, then obviously that would be good news for global markets. I think my concern in the very short term is probably more towards the Europe and the banking sector there, which does have its own problems anyway. So it'd be interesting to see what the ECB response will be, but also in particular Germany's response to this outbreak, which they've been very quiet in the past few weeks.
Andrew, one argument that is being made is that if we look at the broader end of the spectrum right now, while the impact on businesses is not quite known as yet, but assuming that they were stocked up and therefore the disruption until now will not be that major, the indices themselves are very close to the levels that they were at in 2008, right? The peaks we made there, small caps, etc., 11,500. And therefore, there might be merit in trying to start nibbling at some of these pockets, even if the larger view is that let's wait on the sidelines. Is that the argument that you would buy? Why or why not?
Listen, it depends on your kind of your time horizon. Yeah, there's some very good companies. There's some great value out there. But the fear is that, they will get cheaper because we don't know what the response is and the volatility is too high, to say that the worst is behind us. I think there's a few things. One is, if you take that supply chain from China and say that's starting to pick up, the problem is it's starting to pick up into a demand shock. And therefore, it just leads to, the slowdown, which, again, if you go back just a month ago, you'll find most global forecasts were saying this is just a 0.2% hit on the global economy, and now we've quickly gone to, 0.5% and more. So that's where, the moving target is. So, it's not going to be easy to say, here's the right forecast at the moment on any company, across the globe. So I think that's where the market's trying to factor in. Where's the bottom in terms of the earnings or global forecast, and we just don't have that answer. And so we're all grappling in the dark to try and find it. So valuations might look cheap, but obviously, it could be on the basis that forecasts have not yet been actually kind of downgraded. So I think that's what the market is looking at. Well, once the dust settles in all of this, and it does, we do need to see that global response. We haven't talked about oil prices, but if oil prices remain around these levels, then I think there's a change in how we might think from globalization to kind of local growing economies. And I think that's where India will stand out as being more defensive, which it is, and two, would obviously have a growing domestic economy. So I think that's the kind of outcome that you need to look at. But in between time, you're just going to be hit by by kind of news flow, which can be positive and negative. So I think sitting on the sidelines is not a bad thing in the very short term. And I'm talking about weeks here. I'm not talking about months and years. So I think just being a little bit careful is not a bad thing to do.
Andrew, do you believe that the RBI now has a little bit more headroom? Because while crude oil prices have come off, that will have a negative impact on crude price inflation, which gives it that much more of a leeway to tackle the growth issue. And the fact that crude prices at around 30-35 aid the Indian GDP by about 1.4%, that's an incremental positive.
Yes, it is, and hopefully again they'll bring down interest rates. But again, I think if they can target certain sectors, I mean they did last time around. They tried to kind of target the kind of real estate, non-bank financial companies, but in particular the kind of small and medium-sized businesses as well. So if they can continue that kind of flow into those areas, I think that would be welcome from my perspective. So I think, rather than just think about pure interest rates and that, it's really the targeting of industries, which I think we'll all be looking for going forward. The RBI started it in the last policy, and I think they'll need to continue that. So I don't think globally and locally just reducing interest rates is the key. It's reducing interest rates, but also targeting the areas that need it and need it quickly.
All right. Let's talk a little bit more about, just protection buys, safer haven buys, consumption. That's the pocket. You've got Nestle, you've got Britannia, you've got the likes of Asian Paints, D-Mart or Avenue Supermarkets, which have not fallen much. Did you go ahead with these kind of plays right now as safer haven bets? If you had the compulsion to deploy money, I know you said that it's not bad to just sit on cash for the time being, but if you had the compulsion to spend that money, would a part of it go to some of these allocations?
You see, I think that's a place to hide in these difficult markets, and no doubt, once we get through this, then these companies will continue to do well. So the best in class in each of your sectors is where you should be targeting, and that could be in sectors which are suffering as well. So those are the companies you need to identify. Yes, you can hide in the defensives, but once markets turn, it's whilst the defensives will obviously rise with the market, it'll be some of these other companies best in class in some of the other sectors which have been beaten down, which is probably you'll get a bigger return going forward in the very short term. So you just got to try and look across each of the sectors and say, is the worst behind us? If it is, then which company is down, which is best in the class, and which company. So I don't necessarily say if you're going to deploy, it has to necessarily be in the defensives. It's a good area if you want to hide, but I would be looking a little bit below the traditional defensive stocks to say this is where I want to be for once the markets are less volatile and we can see the road ahead a little clearer. Then these are the stocks which would actually give you more outperformance in the shorter to medium term.
Right. Andrew, while we've been pondering over the exits from the foreign institutional investor, at the same time, domestic institutional investors have, if not been matching up, coming very close to matching up to the exits of the foreign institutional investors in terms of the inflows that have been coming into the equity markets. And now with the steady SIP monthly inflow that's been coming in to the tune of about 8,300 odd crores, do you feel that staying out actually you may miss the bus because there is steady money coming into the equity markets on almost a monthly basis?
No, see, I don't, that's a very good point. But, the foreign institutional investors selling is very concentrated all in one go. And therefore, from a local perspective, I'm sure fund managers want to kind of spread that investment, in the falling markets and so forth. What I'm saying is that, just by sitting on the sidelines doesn't mean you can't participate when markets are looking more favorable, because even if you miss the kind of first few percent, does it really matter in a longer term kind of upward move? So I'm just saying, in the very short term, rather than be whipsawed by news which can be positive and negative, more so negative at the moment, you can just kind of quite happily just pick up your favourite stocks across different sectors, best-in-class companies, and then wait for the broader market, to kind of feel more confident that you want to go into the broader market, because there's a change in terms of how the outlook is globally and locally for you to do that. So missing the first few percent in a longer term rise, I don't think is a bad thing. Because we all love to buy the bottom, right? But you have to have a bit of luck to do that as well. So I'm not sure that I would kind of say wholeheartedly now you need to go in, because overnight you could have no news from Trump and then the markets will react to that. The markets will go down until they get the response they want globally.
Right. Yep. And till then, it's a coin toss as to which direction the market opens the next day. Thanks very much, Andrew, for joining in. Appreciate you taking out the time.